What if I told you that a massive healthcare tech company, right? They posted a staggering $92 million loss in a single quarter, just completely tanking their bottom line.
Wow.
Yeah. And their leadership team was so thrilled about the direction of the business that they actually started buying back their own stock.
I mean, it sounds completely counterintuitive. Normally a nearly $100 million creator sends management into panic mode,
Right, exactly.
and investors are just running for the hills. But in the world of hypergrowth tech, a massive loss on paper can sometimes be, well, the loudest signal that a company is actually preparing to take over the market.
Welcome to the deep dive. Today, we're opening up a real Q1 2026 investor deck for an absolute titan in the rapidly expanding digital telehealth and wellness space.
It's a fascinating document.
It really is. Our mission for you today is to decode the business mechanics behind scaling a digital health empire. Like, how does a modern healthcare subscription company actually make its money? How does it balance this explosive global expansion? And maybe most importantly, how does it try to explain away sudden, violent financial dips?
Yeah, and for anyone listening who wants to understand the playbook of these hyper-growth companies, or, if you're just trying to separate corporate spin from actual financial health, we're going to map out exactly what to look for.
Without the jargon, hopefully.
Exactly, without burying you in overwhelming finance jargon. The goal is to connect the dots between the raw numbers in this slide deck and the broader shift happening in global healthcare right now.
I am incredibly ready to peer behind the corporate curtain today. And to truly understand the DNA of this company, I feel like we can't start with their global strategy.
No, you have to look at the foundation first.
Right. We have to start at the absolute core engine of their business, which is how they acquire and keep you, the customer. Because the unit economics of a single user dictate literally everything else on their multi-billion-dollar balance sheet.
They really do.
So, according to this deck, their growth strategy is built on a triad of acquisition, retention, and engagement. But hovering above all of that is one massive, neon-flashing buzzword, which is personalization.
Yeah, and look, personalization is heavily overused in tech marketing. We hear it everywhere.
Oh, constantly.
But what's crucial to understand here is that the data actually supports the buzzword in this case. This isn't just a shiny feature to talk about in press releases.
It's more structural than that.
Exactly. It represents a fundamental structural shift in their revenue model. If you look at the company's historical growth over the last couple of years, the number of non-personalized subscribers has completely flatlined.
And those are the users just logging on for like standard one-off treatments.
Generic care. That group has been sitting right around 0.9 million users for a while now, just up there.
Yeah.
But the personalized subscribers, that number surged by 20% year over year,
Wow.
hitting 1.7 million by the start of 2026.
I like to think of this shift like buying a suit. The non-personalized generic care is your off-the-rack suit. You walk into a department store, you grab a size 40 regular, and it gets the job done.
Right, but covered you.
Exactly, but the sleeves are a little long, the shoulders are a bit tight. It's not really made for you. The personalized care model they're pushing, that's bespoke tailoring. They are adjusting the fit, the fabric, the style specifically for your unique biology.
That's a great analogy.
Thanks. Because if you're a consumer, why would you stick around for generic, off-the-rack medical advice when an app is offering you a custom fit? And looking at the numbers, the financial impact of migrating users to that custom fit is massive. I mean, their total revenue basically doubled.
Yeah, from around $316 million in mid-2024 to over $608 million in Q1 of 2026.
That is wild.
And it isn't just that they've acquired more total users. The critical metric here is that each individual user is willingly paying more money. The average revenue per user, which is often called ARPU in these decks, jumped from about $59 a month in Q2 2024 up to $85 in Q1 2025.
Before it sort of stabilized around $80, right?
Right. They are successfully walking their entire customer base up the staircase to higher value premium tiers of care.
Okay, I have to step in here because that jump raises a massive red flag for me as a consumer. Raising a monthly subscription from $59 to basically $80 is a steep hike.
It is a big jump.
And at the same time, I see their payback period, which, for the listener, is how long it takes the company to recover the marketing dollars they spent to acquire that new customer in the first place. That payback period is hovering around just 7 months in 2025.
Which is incredibly fast.
Right. Getting your marketing money back in 7 months is a dream scenario for a software company. But is jacking up the monthly revenue to $80 actually sustainable? Or are they just, squeezing their current users for every dime until those users eventually look at their credit card statements, get fed up, and cancel?
Well, squeezing users for short-term profit is a really common pitfall, and you're right, it usually results in massive churn, people deleting the app and just never coming back.
Yeah, I've done that plenty of times.
We all have. But this is where their retention strategy fundamentally alters the math. The deck highlights a long-term retention rate of over 85%.
Over 85%.
Yes. For a digital health subscription, keeping 85% of your users long-term is exceptionally high.
That's almost unheard of for an app-based subscription. Usually people sign up, use it for 3 months, and bounce.
Exactly, and they bounce because the generic service stops offering new value. The strategy here is migrating users into a multi-condition integrated ecosystem. They aren't just sending you a pill in the mail anymore.
What are they doing instead?
They're providing proprietary health products, access to clinical expertise, and daily tracking tools, things they call care companions.
Okay.
So as you use the service, you log your habits, your symptoms, your progress. And this creates incredibly high switching costs.
Oh, I see. Because the app has all your data.
Right. As the customer, you feel like the platform understands your unique biology better with every passing month. If you leave for a cheaper competitor, you lose all that historical data and that custom fit.
So the friction of leaving is just too high.
Exactly. That friction makes you far less likely to leave, even if you're paying $80 a month.
Okay, let's follow that logic because this is where the story gets a little crazy to me. We have a company with an incredibly sticky ecosystem. The users are happily paying more every month. They have an 85% retention rate, and they earn back their customer acquisition costs in just 7 months.
Right. The fundamentals are amazing.
By all conventional business logic, this thing is a flawless money-printing machine. And yet, despite these beautiful unit economics, the company's profitability suddenly took a nosedive in late 2025 and into early 2026.
A very sharp nosedive.
Why would a company with such a perfect engine suddenly start bleeding cash?
It is the ultimate profitability paradox. And to decode what's actually happening, we have to look at how they measure money coming in versus money going out. Because there are two different metrics in this deck telling two very different stories.
Which are?
Adjusted EBITDA and net income. Adjusted EBITDA is a measure of operational profitability. Think of it as how much raw cash the core business engine is throwing off from its daily operations before you account for taxes, interest on debt, and weird one-off accounting items.
Right, so it's the heartbeat of the daily business. Are we selling our bespoke suits for more than it costs to make them?
Exactly that. And that operational metric peaked beautifully at $91 million in Q1 of 2025. That represented a very healthy 16% profit margin.
Okay, 16% is great.
It is. But fast forward a year to Q1 2026, and that operational profit is projected to drop by more than half, down to just $34 million. Their margin shrinks to just 7%.
Ouch. And the net income, which is the actual unadjusted bottom line of the bank account, is an even harsher reality check, right?
And harsher.
Because back in Q2 of 2024, they showed a clean, straightforward $13.29 million net profit. Fast forward to Q1 2026, and they posted a massive $92.11 million net loss, a $92 million hole.
Yeah, it's a huge swing.
But here is what drives me crazy. When you look at the official corporate spin in the presentation, management waves their hands and cites a, quote, temporary headwind caused by weight loss shipping cadences.
Yeah. Whenever management points the finger at a vague supply chain hiccup to explain a massive swing in profitability, you have to immediately go read the fine print at the bottom of the slides.
Wait, I'm looking at the line items for that Q1 2026 net loss right now, and the math just screams that this has almost nothing to do with shipping boxes of weight loss medication.
Let's hear it.
Down here in the footnotes, they list $33.48 million in reorganization costs, a $15 million legal settlement, another $13.36 million in M&A, mergers and acquisitions costs, and over $9 million in taxes. Are they seriously trying to sweep major corporate structural overhauls and lawsuits under the rug by calling them shipping delays?
Skepticism is completely warranted here. What's happening is a classic case of selective corporate communication. The company is technically telling the truth about the operational margin.
How so?
That EBITDA dropped from 16% down to 7%. That likely is heavily influenced by supply chain bottlenecks and their new, highly popular weight loss category. That core cash generation weakening by half is a genuine operational warning sign that investors need to watch.
But a bottleneck in the warehouse does not explain a nearly $100 million crater on the bottom line.
No, it doesn't even come close. The massive net loss is entirely driven by those one-off non-recurring expenses you just found in the footnotes. Lawsuits, corporate restructuring, buyout fees.
So it's growing pains, basically.
Extreme growing pains. When a company spends $33 million just to reorganize itself, it means they're tearing down the old house to build a skyscraper. They're absorbing intense, short-term financial pain to build the infrastructure required for massive global scale.
Right. They're essentially paying the toll road fees right now to become a multinational giant tomorrow.
Exactly.
So if they're happily bleeding tens of millions of dollars on legal settlements, restructuring schemes, and acquisition fees, where exactly is all that new capital and infrastructure being deployed? A company doesn't tear down the house just to stay in the same neighborhood.
No, they definitely don't.
And when you look at the cash flow statements, the new neighborhood they're moving into, it's international.
Oh, the cash flow data over this 25 to 2026 period is a wild ride. Following a major fundraising round, their cash reserves absolutely skyrocketed to over $1.14 billion in Q2 of 2025. They were sitting on a massive war chest.
But having money in the bank doesn't mean you're generating cash. Because in that exact same quarter, their free cash flow hit negative $69 million. They had $1 billion in the bank, but they were burning through cash at an astonishing rate.
Right, and the reason for that burn rate comes down to capital expenditures, or CapEx.
Let's define that for the listener real quick.
Sure. CapEx is the money a company spends to buy, maintain, or improve physical assets, like buying servers, building compounding pharmacies, or acquiring other businesses outright. In Q3 of 2025 alone, they dumped over $65 million into physical assets.
Wow.
So they weren't losing money because the app was failing. They were spending money to conquer new territory.
And what a conquest it is. When you look at the results of that spending, their international revenue grew an absurd 10x year over year. It jumped from just $7 million in Q1 of 2025 to $78 million a year later in Q1 2026.
Yeah, massive.
I want you to really think about the scale of that move. They aren't just planting a couple of exploratory flags in London or Tokyo to test the waters. They are buying the whole field.
Buying the field is the literal strategy here, because when you want to enter a heavily regulated healthcare market in a foreign country, you don't build it from scratch.
Too much red tape.
Exactly. You buy the local players who already have regulatory clearance, established networks of local doctors, and regional brand trust. This 10x international explosion was fueled by 3 massive strategic acquisitions.
Okay, let's go through them.
First, they executed the July 2025 buyout of a company called Zavai, which instantly unlocked the UK, Ireland, Germany, and France.
That is a huge chunk of the European market just acquired overnight.
A few months later, in November, they launched H&H Canada, securing a dominant foothold in North America. And finally, the crown jewel of their shopping spree was the February 2026 acquisition of Eucalyptus.
Eucalyptus, where does that get them?
That deal dramatically expanded their reach into Australia, Japan, and the broader Asia-Pacific region.
Okay, but here's my underlying concern with this global domination playbook. With all this heavy capital expenditure, the quarters of negative free cash flow, the $15 million legal settlements, and the tens of millions dropping on European and Australian acquisitions.
That's a lot of cash going out the door.
It is. So is the core business, the folks back home paying $80 a month for a personalized care companion, is that original engine actually generating enough cash to fund this global shopping spree without the whole company eventually going broke?
It's the ultimate test of a hyper-growth model, right?
Yeah.
Can the core fund the frontier? And the data here strongly suggests it can.
How so?
Because while they took a huge free cash flow hit in mid-2025 to buy these companies, their operating cash flow, the actual cash generated by their regular day-to-day business activities, bounced back rapidly to a record $148 million by Q3 of 2025.
Oh, wow. So the core engine recovered from the spending shock incredibly fast.
It proved its resilience. The core engine of $80 a month loyal subscribers is robust enough to continuously fund the heavy capital expenditures without draining the billion-dollar war chest dry.
That makes total sense.
Furthermore, management is aggressively proving to investors that they aren't just buying foreign companies for vanity metrics. The eucalyptus deal alone is projected to build a foundation for over $1 billion in annual revenue within 3 years.
$1 billion.
Yes, that shows a clear, massive return on investment for the short-term cash burn.
So they've bought the global infrastructure, they've absorbed the financial pain of reorganizing, and they've locked in a highly profitable core user base. Which brings us to the most fascinating part of this deck, I think. Their vision for the end of 2026 and beyond.
They're aiming very high.
They really are no longer hiding their ambition. They are projecting between $2.8 billion and $3.0 billion in total revenue for the year 2026. That represents a massive 19 to 28% growth rate on an already huge base.
And they also project that the adjusted EBITDA, that daily profit engine that took a hit from the supply chain issues earlier, they expect that will fully recover, landing between $275 million and $350 million.
So the margins get better too.
Right. That brings their operational margins back up to a very healthy 11%.
And as part of that growth, they are predicting that their HERS brand alone, just the segment dedicated to women's health, will cross the $1 billion revenue mark by itself.
Which is an incredible milestone.
But digging into these forward-looking slides, it's not just about getting bigger. It's about fundamentally changing what this company actually does. Because they started back in 2021 doing simple transactional telehealth, right? Generic dermatology creams, basic sexual health prescriptions.
Very straightforward stuff.
Right. But the 2026 vision is a massive pivot into deep tech and highly complex medical specialties.
This pivot is the key to understanding their end game. They are moving aggressively into data intelligence. The deck details how they are integrating your bio at-home blood tests directly into their platform.
At-home blood tests.
Yeah. And they're leaning into incredibly complex pharmaceutical partnerships, like teaming up with Novo Nordisk for weight loss management, and they're even pushing into innovative cancer screening technologies.
Let's walk through what that actually looks like for a user. Previously, you might log on, answer a questionnaire, and get a generic prescription mailed to you. But now, a clinical kit arrives at your door. You prick your finger, you send your blood back to a lab that the company likely owns or partners heavily with.
Exactly.
And then a week later, a custom compounded medication formulated specifically for your exact hormone levels and biology arrives at your door. The app then tracks your daily vitals to see how the medication is working. I mean, are they trying to step entirely out of the wellness niche and just replace traditional in-person primary care altogether?
Yes, that is exactly the ambition. If you tie this new deep tech pivot back to the personalization buzzword we started with, the ultimate strategy becomes obvious.
It's all connected.
It really is. It's no longer about acquiring a casual subscriber to fix a single temporary issue. It is about creating a fully closed-loop healthcare ecosystem. They want to own the diagnostics through the at-home blood tests. They want to own the treatment through their compounding facilities and their heavyweight pharma partnerships.
And they want to own your ongoing daily tracking through their app and those care companions.
Exactly.
And the deck states that every time they launch one of these new complex specialties, it creates a $100 million annual revenue opportunity. They are vertically integrating the entire healthcare experience, from the blood draw to the daily pill to the data analysis.
And if you want to know whether the company's leadership truly believes they can pull off this massive, incredibly difficult transition, you just have to look at their actions in the stock market.
The buybacks.
Right. The final slides of the deck note that they still have $225 million remaining in an active $250 million share repurchase program.
A stock buyback. For those who might not track corporate finance day to day, a stock buyback is when a company uses its own cash reserves to buy its own shares off the open market, essentially retiring those shares. It is the ultimate signal of leadership betting on themselves.
Yeah, putting their money where their mouth is.
They are looking at the market and saying, you know, Wall Street thinks our stock is undervalued because they're spooked by that $92 million loss. But we know what we are building, and we are confident enough in our cash position to buy our own equity on a discount.
It is a profound signal of management confidence.
Yeah.
They're telling their investors, look, we know the Q1 2026 net loss looks terrifying on a headline, but we believe this transition into a global deep tech health ecosystem is fully funded, the pain is temporary, and the strategy will succeed.
When you step back and look at the entire narrative woven through this deck, the playbook for scaling a modern empire becomes so clear. We started by unpacking the brilliant unit economics of their model, how they used the promise of a bespoke, personalized care companion to drive monthly revenue up to $80.
while creating a sticky ecosystem that keeps 85% of users locked in.
Exactly, paying back their marketing costs in just 7 months.
And from there, we navigated the incredibly messy reality of their financials. We saw how a staggering $92 million net loss wasn't actually a sign of a failing business or a simple shipping delay.
It was the heavy toll of doing global business.
Right. It was the cost of legal fees, tearing down corporate structures, and paying the premium for aggressive global mergers.
We followed that CapEx cash directly into their international explosion, watching them multiply their overseas revenue tenfold by buying up established players across Europe, Canada, and the Asia-Pacific region.
And finally, we looked at the grand vision for 2026 and beyond.
Evolving from a simple app that mails you generic prescriptions into a multi-billion-dollar, vertically integrated health data giant that partners with pharma titans and analyzes your at-home blood work.
The ultimate lesson here for you, the listener, is how to properly evaluate a hypergrowth tech company. The next time you see a massive quarterly net loss screaming across a financial headline, don't just panic and assume the company's dying.
You have to look deeper.
You really do. Look deeper into the mechanics. Look at the payback periods. Look in the user retention rates. And critically, look at exactly where the capital expenditure is flowing.
Because a company burning cash just to keep the lights on and pay rent is a failing company. But a company burning cash to buy global infrastructure, acquire proprietary technology, and reorganize for scale is a company building an empire.
Building a truly global empire indeed.
But as we wrap up this deep dive, I want to leave you with one final thought. This company is brilliantly executing a strategy to become the ultimate frictionless healthcare provider. They are building a closed-loop system that tracks your daily habits, analyzes your at-home blood tests, and supplies your custom compounded medications based on your unique biology. It is the absolute pinnacle of convenience.
It really is.
But at what point does the sheer seamless convenience of this bespoke, personalized care outweigh the privacy implications of one single multinational corporate entity holding your entire biological, pharmaceutical, and psychological blueprint? It is certainly something to ponder the next time you quickly scroll to the bottom and click agree on the terms and conditions.